The world is changing, days of fire and chaos are coming, and if you want to save yourself from the economic abyss, you should pay attention to this video. Today we are going to talk about Jim Rickards and his dark forecasts for the economy. We will see an analysis of the famous and legendary James Rickards and what his peculiar views are regarding the behavior of the economy in the immediate future. We begin by commenting on the rise in 10-year Treasury yields, which have risen above 1.8%, the highest level in the last 2 years. Admittedly, we can say that this would be small compared to previous years, but the need for central banks to keep rates ultra-low has been evident in recent times. Jim Rickards also comments that this rise in Treasury yields may have an impact on mortgage performance and the construction sector. Rickards also launches a criticism, and that is that he does not see a clear link between money printing and the rise in inflation. That the inflation we have seen in recent months has been due to the rise in commodities. Regarding money printing, Rickards says you have to focus on one concept, the so-called velocity of money. The ease with which money changes hands, the ease with which money is lent or spent. And printed money does not necessarily generate more borrowing and more spending. And one of the factors that explains this is the enormous weight of debt. Debt borne by households and debt borne by businesses. Because if a person is in debt, even if his income increases, he does not necessarily have to spend more. In recent years, more and more money was printed, and that money was trapped in the reserves of the banks, and there ended up being too much money in those reserves, money that the banks could not use for profitability. There ended up being too much money in these reserves, money that the banks could not use for profitability. So what did the Federal Reserve do? It came up with a minimum interest rate to take money out of the bank's reserves. It offered these banks to put this excess money in their reserves and get a very low interest rate in return. This process served to drain liquidity from the market to the tune of $2 trillion in this last year, in 2021. And what is the behavior of the population? People are insecure about their future, and because of this, they tend to save more and spend less. Rickards believes that inflation will moderate this year, although it will then resurface strongly, as we will see in this video. Jim Rickards is betting that the US economy will gradually slow down, and this will be exacerbated by the Federal Reserve's interest rate hike. Let's now look at the performance of the Federal Reserve's balance sheet. In 2008, the balance sheet totaled $800 billion, from there it rose to $4.5 trillion and fell to $3.7 trillion as they tried to raise interest rates in 2018. Now the US has official inflation of 7%, a balance sheet of $8 trillion, and an economy enduring lower and lower rates. In 2018, the stock market fell 20% after tripling in previous years through quantitative easing programs. And despite the stock market having tripled, a 20% drop served to cause the Federal Reserve to back off its rate hike program. Rickards tells us that in the coming months history will repeat itself. There will be an attempt at monetary normalization, there will be a fall in the stock market, and then the Federal Reserve will withdraw if necessary. And it is at that moment when he comments that there could be a massive printing of money, and then the printing of money could affect inflation, and he believes that inflationary rates could shoot up.